Welcome back. In this unit, we're talking tax. That is, the duties of tax professionals as specified by the AICPA Statements on Standards for Tax Services, which I'll refer to as statements in this video, as well as the IRS Circular 230. These standards are necessary because tax accountants serve a dual role. First, tax accountants advocate for their clients. Nobody wants to pay more taxes than they owe, and a tax accountant helps evaluate how much their clients owe to the IRS. But tax accountants also act on behalf of the IRS to broker tax collection, creating a duty to the tax system. The statements in the circular provide guidance on what a tax professional should do when these two roles are at odds with one another. Let's go into a little bit of description of the statements and the circular. The statements are applicable to CPAs. However, various states and courts of law have used these standards to evaluate tax professional liability. Circular 230 is applicable to all those who practice before the Internal Revenue Service. This includes CPAs, lawyers, actuaries, enrolled agents, and other persons as necessary and as approved. The statements address how a tax professional should prepare returns, provide taxpayer representation, and render tax advice. The circular specifies what is required of tax professionals to maintain a good reputation with the IRS and the consequences of failing to maintain this repute. There are 7 different standards promulgated by the AICPA. We'll spend a little bit of time on each one of them as they each impose different duties and responsibilities on tax professionals. The first standard pertains to taking a position on tax returns. A taxpayer, from the perspective of a tax professional, is the party that receives tax services. This can be a client, an employer, or a different third party. The tax professional helps the taxpayer determine a position on the tax return, which is a proposed or actual stance on a tax matter. The tax position describes how an income or expense item is or should be reported on a tax return, and it's made given the advice and consultation of the tax professional. With regard to advising tax return positions, the preparer has a duty to abide by the appropriate standards. In the absence of a specific standard or a more stringent standard, this entails making recommendations on good faith and with a reasonable basis. And we'll talk about those different standards on the next slide. The preparer also has a duty to make the taxpayer aware of the consequences of taking an aggressive tax position. If you've taken a tax research class, you know that there is some ambiguity in the tax law. The IRS seeks to clarify that ambiguity with their regulations, but still, sometimes it's necessary to take their tax claims to court. In such cases, the case law resulting from those court decisions becomes de facto tax authority. All this to say that there are varying levels of support that can be used to justify an uncertain tax position, where an uncertain tax position is a tax position where the law or authority is somewhat ambiguous. There it is. Let's look at these And I've set this slide up like a thermometer to show which is the lowest authority and lowest support for the position and which is the highest. So the first standard for an uncertain tax position is this support can't be frivolous. The position can't be frivolous. A frivolous position has a low chance of being sustained. Examples of frivolous positions that people have tried: a person claims that they're not from planet Earth, thereby they're not a legal person as defined in the tax code and aren't required to pay taxes. Another person might believe that for religious purposes, they're not bound by the United States Constitution and thereby do not have to pay taxes. These would be thrown out immediately. The next higher level of standard to support a tax position is a reasonable basis. In this case, the support for a position is viewed favorably by at least one authoritative source. As an example, a tax position is supported by a single relevant court case. The sustainment odds here are 1 in 5 of being upheld by either a court or the IRS. The next highest level is a realistic possibility of success. And these are standards that have merit of their own accord and are relatively likely, and by relatively likely, I mean 1 in 3 odds of being upheld. The next claim is substantial authority, and this is the basis by which you would have applied the tax code in your tax research classes. This is a claim that's supported by substantial authority. The tax code, the federal regulations promulgated by the IRS, and the case law. These have a relatively high chance of being sustained, 2 in 5, provided that the substantial authority is relevant. And the highest standard is more likely than not. This is a position that's supported by the preponderance of the evidence. The odds of this being sustained is 50%. So the second standard addresses answers to questions on returns. The preparer has a duty to make a reasonable effort to obtain whatever information is necessary to prepare the tax return. Reasonable effort entails asking enough questions to avoid omitting key items. And these are items that, if they were omitted, would detract from the quality of the return. The tax professional should request enough information and additional information to support required tax disclosures. Finally, reasonable effort requires the tax professional to collect enough information that she can, in good conscience, sign that the report is true, correct, and complete to the best of their knowledge. Reasonable effort, however, has limitations. In certain circumstances, the information is not readily available. As long as tax consequence is the same with or without that information, the tax preparer's reasonable effort to obtain information is sufficient. If genuine uncertainty exists, the taxpayer's reasonable effort is sufficient. And finally, if the taxpayer, in seeking information, discovers that the answer to that question is voluminous, then simply taking their best effort and their reasonable effort to get this information is sufficient. The third standard relates to the preparation of returns. The preparer or the tax professional has a duty to make reasonable inquiries of the client if something doesn't feel right based on the supporting tax documents. For example, if the taxpayer provided documents that were in direct contrast to what the taxpayer had claimed, the preparer should ask questions. The tax preparer should also corroborate statements from the taxpayer to the extent possible. Here's an example from the book. If the tax professional completes the return for both the husband and his ex-wife, and the tax professional notes a discrepancy between the two, the tax professional should take every possible effort to corroborate which is the correct story, but should do so without violating their confidentiality and their privacy. In short, in preparing the return, the tax professional should trust what their clients say, but should verify that information. As an example, the prior year return is a great starting point. The fourth standard adheres to the use of estimates. As in accounting itself, judgment is required. Where judgment is required in the accounting, the same judgment and estimation may be required in the completion of the tax return. The tax preparer may use estimates unless their use is prohibited by law. This would occur with travel usage, which is an item that can be easily manipulated. The preparer may use estimates if the exact data is not readily available, and if the estimate is reasonable based on known facts and circumstances. As an example, I received some inheritance from my grandmother's estate. I did not receive the documentation from the bank until April 7th. Had I prepared my tax return earlier in the tax year, I would have had to make a reasonable estimate based on known facts and circumstances to complete my return. With regard to estimates, a tax professional should use caution and discretion. The estimate used should not be so specific that it looks fake. For example, if 700 shares of stock were sold at $1 acquisition price each, I can estimate the basis of around at $700. I don't have to give an exact number. I also don't have to disclose the circumstances in which an estimate was used, unless certain facts apply. These are described in the standard. The fifth standard addresses departure from a position that's been previously established. If you've taken a tax research class, you know that what's been said is what goes. This is the doctrine of stare decisis. And usually it holds, but the preparer does not have to abide by that standard indefinitely. For example, if missing or unavailable support has become available, if the taxpayer's circumstances have changed, and if new court decisions are available that justify taking a given tax position, it's okay to depart from that stare decisis. The sixth standard applies to the tax professional's knowledge of error, be it intentional or unintentional. The tax preparer has a duty to advise the taxpayer of the consequences of the error. If it's an unintentional error, the tax preparer should recommend amendments as well as make sure to correct the error in future returns. However, if the taxpayer declines to make the amendments or refuses to correct the error in future returns, the tax professional should consider withdrawing from future tax engagements. Finally, the seventh standard pertains to the content of taxpayer advice and the form of taxpayer advice. what it should be, and what it should look like. The tax preparer should know that any advice comes from the tax professional will likely be relied upon by the taxpayer. Therefore, the tax preparer has a duty to provide communication that meets the taxpayer needs, that, given their tendency to rely on such communications, applies relevant authority, or at least a reasonable basis. The communication should make the taxpayer conscious of the penalty for error or omission, and the conversation should exercise appropriate professional judgment. And a number of factors go into the exercise of professional judgment. I've listed several of them here. In closing, it's important to note that the statements promulgated by the AICPA are designed to complement and expand upon IRS Circular 230, which establishes the duties and responsibilities of those persons who practice before the IRS. Some of these duties include promptly responding to IRS inquiry, advising clients on the penalties for noncompliance with the tax law, including taking an aggressive tax position, applying due diligence in all aspects of work, returning original client-furnished records, avoiding client conflicts of interest, and if these conflicts are pursued, establishing corrective actions and obtaining signatures to allow such conflicts to exist, presenting oneself honestly when soliciting for clients and advertising their services, possessing the necessary competence to practice before the IRS, and for those who work in a tax firm or a business office or a law firm, ensuring that the firm employs a compliance structure. The consequences for violating a statute within the circular are quite weighty. A person who violates these standards can lose the ability to practice before the IRS. They can also face a number of financial penalties as well as criminal penalties.